Now, finally, let's talk about drawdowns. So, the market at some point will move against you in your trade ideas. This happens to everyone. The basis of risk management, everything that we just spoke about, is if the trader manages his or her risk well, they can lose a trade and not lose all of their money at once. Whether that means they're not getting stuck in a position because the market went against them, the market crashed, and they're not stuck in that position for 6 months. They're not getting liquidated, or they don't have to sell at an extreme loss. Maybe that stop loss or their risk management just takes a smaller loss, a controlled loss. We want to control our losses and control our gains. We want to have as much control over our trading environment as possible. Now, recovering from those losses is psychologically difficult, and it can become progressively harder to do so if you continue losing. If you're constantly in these losing trades, you're going to kind of get in the mindset of being a loser. I mean, this is just the reality of anything where you either win or lose, right? Think of baseball games. If you're on a losing team that constantly is losing, it's going to be even harder and harder for you to win when the time comes to play again. Now, to mitigate the impact of drawdowns, you should consider, do you have rules or a system for entering a trade? Are you planning out your trades, or are you just gambling? Are you just entering in and seeing how it goes? Are you just letting it ride? Have you been following said rules or said system? Like, how closely are you following? Are you following every single rule or detail? Are you tracking all of your trades? When you could do that, you can start to find commonalities between the winning trades versus commonalities between the losing trades. Maybe you find that you're always winning trades when you enter in at a certain time of the day, or when you're entering in based on a certain day of the week. Maybe something's happening during those days. Maybe your emotional state or your mental state is better. Maybe you trade better in the morning because you're more refreshed and you just woke up, as opposed to at night when you're tired and you have less focus because you've been out working all day. So these are things to track and to subjectively and objectively take a look at, right? And this is part of tracking your trades, looking at that data, seeing exactly what goes right and what goes wrong. Now, with that, you might want to consider reducing risk and increasing the quality of setups or the trade entries you take. With that, similar to what we said before, instead of opting to take that trade with that 10% possible risk or 10% stop loss, you might want to just look for a better setup or something with much less risk involved. That way, you are closer to the base of whatever position or market direction you're looking to go. If you're looking along, maybe you're closer to the bottom, or you have a clearer signal or a clearer indication. You're waiting for that chart pattern to close out, or for the candle to close to really give more confidence in your trade and in your setup. Another thing is, can your win rate and risk-reward ratio handle a losing streak? How many losses can you take before you're out of money, right? Or how many losses can you take before you're not profitable anymore? So this is something to consider as well, looking at that chart in the previous slide. You might also want to consider, do you need a break? Are you taking FOMO being fear of missing out, trades where you just see the market pump and you think, oh man, I can't miss out? Are you just jumping in and then failing to realize that you just entered at a level of resistance and then you just bought the top? Or are you taking revenge trades often? You just lost a trade and you feel like you need to make that money back. You just lost $1,000. I have to immediately enter in another trade because I need to make that money back because I need to pay for something, or I need that money. Revenge trades are one of the quickest ways to lose all of your money. And typically, I highly suggest not to do that. It's hard to get caught up. Sometimes it's hard to remain clear-minded, and you can get caught up in that, where you take a loss and you feel like you need to make it back up, you need to be in a trade. There's no need to always be in a trade. It's always better to just be patient and to wait for the trade to come to you. Let the opportunity show itself, and you'll know when it's there. If you've been doing your research, if you're learning about trading, if you're doing the homework, learning about market structure, how to read the indicators, all of those things, you'll see the setups there, instead of forcing them, because forced trades eventually will not work out. And when you continuously force trades in environments that they're not meant to be forced, you will suffer drawdowns, and it will be one of the fastest ways to lose all of your money. Really, the key in trading, above all else, is longevity. It is a marathon, not a sprint. So here's a figure of a chart looking at drawdowns, particularly if you were to take a drawdown here, on the left side of any of these numbers. On the right side, this is the amount that you would need to make in order to break even. So if you take a 5% hit on your account, you need to make 5.3% from that bottom position in order to make back up that money that you lost. Remember, it's always easier to go back downwards, right? Or whatever. If you're losing money, you need, in order to get back that money, the percentage needs to be higher than the actual loss, because you also have to factor in transaction fees as well. If you're taking a 10% drawdown, you need to make 11.1%. Let's say you were to take a 50% drawdown. You need to make 100% on that same exact trade, the same asset, to make back that money. And it continuously gets worse and worse the larger the drawdowns, which is why we highly stress you really want to limit your losses. You want to limit your drawdowns, because if you have a stop loss in place, you are limiting a stop loss, especially a stop loss of 5%. You are limiting the amount of loss you take, and you are limiting the amount that you need to make up that loss to just 5.3%, as opposed to if the market crashes and you take a 40% drawdown, now you need to make back 67% on a trade in order to break even, which is a significantly higher percentage increase compared to from 5 to 5.3. Here's a chart. This is pretty interesting. This is the probability of seeing at least X being consecutive trades, consecutive losing trades within a 50 trade period. And this is all based on your win rate in this X and this Y axis on this left side. The X axis would be the probability of seeing at least at X amount of consecutive losing trades within a 50 trade period. And these are studies realistically based off your win rate percentage. So let's say we have a 50% win rate percentage, right? We win half of our trades, we lose half our trades, and we've done this. We back tested, we journaled and documented 50 trades, let's say over the course of 2 months, and we found that we have a 50% win rate. And we also can calculate that based on our once again the calculation we showed before with our risk reward ratio, and based on the kind of trades we're taking. So we have a 50% win rate. The probability of seeing a 2 consecutive losing trades is 100%. At some point, we will see 2 consecutive losing trades. How often, we don't know, but at some point it will happen. Now, if we maintain this win rate, gradually this will diminish. So out of 11 trades, the probability of seeing even more consecutive losing trades goes down because our win rate is high. Now, if we only have a 20% win rate, the chances of seeing consecutive losing trades with a 20% win rate goes up. That means you are, when you have such a low win rate, when you're taking on such a great amount of risk, the chances of you seeing those losing trades gets exponentially higher and higher, right? Or it's just overall you are more guaranteed to see these losing trades compared to if you have a higher win rate. Let's say if we have a 70% win rate. The chance of seeing 2 losing trades, 99%. The chance of seeing 3 losing trades in a row, 73%. The chance of seeing 4 losing trades in a row, 31. So this is a significant drop in the chance of actually losing another trade. So if you lost 3 trades in a row using the same setup, the same rules, the same system that you have established, and we are starting to track and analyze that system, how successful is this system over time, over a 50 trade period? On that, if we've lost 3 trades in a row and we're still using that same system, we haven't changed any of the parameters, the chance of losing that 4th trade is getting extremely lower. And as we continue to trade more and more, the chance of losing that next trade goes down to near nothing, to 10 on the 10th and 11th. It says 0.0%, but that would be even lower. It would be microscopic percentage chances. Now, all of that is facilitated, all of that analysis on your trading performance can only be done through the use of trading journals. So documenting your trades in a journal or a log provides an unbiased view of your trading history and performance. The key to this is that it removes the emotional attachment to your performance. You can see exactly how your trades performed over a period of time when all the data is laid out clearly. It's not just in your head. It's not just going off of your memory or of how you felt about that moment when you enter the trade, your emotions, or your day-to-day life. It's all hard facts. It's all hard data and numbers, and that's hard to refute. Concrete numbers when it's laid out in front of you. It also allows you to quickly and filter trades. Here we can see what went right here versus what went wrong. And we can start to analyze and pick apart what we want to stick with over a period of time and what we may want to change or alter. Maybe you want to change the amount of risk you're taking on or slightly alter your setups because the data from your trading journal indicates that something is going wrong. Generally, they overall improve your trading performance because now you have something to hold yourself accountable to. Now, basic information necessary includes you may want to add the date and the times, the trade entry, exit prices, the position size, essentially how many of a coin you're buying, how much Bitcoin you're buying at a specific time, how much Solana are you trading at in a given trade. You could do that in terms of the actual coins itself, or also in terms of the fiat amount, maybe in US dollars. Also tracking the percentage of gains lost per trade, the net profit and net loss in terms of fiat or in terms of crypto on each given trade, and also the asset itself. What are you trading? You might want to add in that symbol. I traded $120 link and I gained 5%, and it took me 3 days. And then you would log that into your trading journal. Now, these are basic data entries or basic inputs for our trading journal. You could add more advanced information such as your stop loss or target levels, the direction, whether or not you went long or short, the general strategy of the plan, what gave you this impulse, what is the basis of your trade idea, your risk to reward ratio, your win rate tracker up to that point, and how your win rate has evolved over time, and more. It really depends how advanced you want to get into it, I just highly suggest at least starting with this. You don't have to get this involved with trading journals. Just know that they can become much more involved. It just depends on how far you want to take tracking your performance. At least tracking the dates, times, trade entries and exits, position sizes, all of this will give you a solid, concrete foundation for starting a trading journal. Now here's an example of a trading journal. This is obviously this is an older one, but the same concept remains true whether you're trading stocks or you're trading crypto, forex, futures, options, whatever it is that you're trading. The concept remains the same. You would track them. You could use a spreadsheet. You could use an Excel document. Some people use just a Google document or a Word document and type it in, all like that. I prefer to use a spreadsheet. I find it to be neater and much more organized, especially if I'm making a lot of trades throughout the year or throughout the quarter. You would label it by your trades, your dates, the symbols, whether it was a long or a short. This is just one example. The quantity, the size of the positions, you bought at what price, you sold at what price, the initial risk that you took on, the fees, a commission or the fees, particularly for crypto exchanges, and then also finally your profit and loss. Going within profit and loss. So a P&L, this is just a summary of financial information such as revenue, costs, and expenses taken on during a period of time. This can be made in the format of daily, weekly, monthly, quarterly, or yearly P&Ls. For traders, you might find it very helpful to use weekly, monthly, and quarterly P&Ls, particularly monthly and quarterly, I find are the most useful. Not every week is going to be the same. Not every month is going to be the same. Not every quarter is going to be the same. But tracking your progress on a month-to-month basis, seeing what you're doing right, seeing what you're doing wrong, is very helpful in my experience and in many other traders' experiences. Profit and loss essentially is just an expanded format of the trading journal that we spoke about before. It stands for profit and loss, and it's either in the realized or unrealized format. Open positions are unrealized, right? When you have money in an investment, let's say you have $100,000 in Bitcoin and you bought in when it was 5,000, and it expanded so much over time. That is an unrealized gain because you haven't sold yet. So you really only make that money until you actually sell or close the position. When the open position is closed, the unrealized P&L becomes realized, and that's when we can start to track and hold accountable the reality of the gains or the losses. A realized P&L is formulated based on the entry and the closing price. It is based on the profit or the loss that came from those closed positions. An unrealized P&L is based on profit or loss on positions that are still open. So that position has not been closed. It still could go up. It still could go down. There is no definitive, hey, I made this much off of this, because the profit hasn't actually been solidified. The position hasn't been closed.